Hi, my name is Dion Rebello, and this is the Bullion Vault. Hi, Willem. How you doing?
Well in yourself, Dion.
Good, thank you. So, episode 36. We've been getting and stacking them quite consistently, as we mentioned the other day. I mean, I think we've in the full duration since December last year, we've missed 1 week
Yeah,
of recording.
that is indeed the case. It's been starting to become quite the long running show here.
Yeah, and again, I think the important thing is we big believers in the content we're putting out, and the importance of it in a world right now that is very, very uncertain on every level. You know, you look at geopolitically, you look at politically, both internal and external politics. Um, it's a mess, to put it bluntly, and I think bullion does offer a vehicle for some kind of reassurance on wealth preservation, and that's we've gone on, I think, so many times, but again, there's so many angles that we look at that makes it worthwhile to get this information out there. And I always say, for me, whenever we do these discussions, and if I've had a discussion with a person that's interested in bullion as a possible form of wealth management or wealth preservation, and after that discussion, you can see there's a almost a paradigm shift because I never believed that bullion could actually offer these characteristics of wealth management and preservation.
Yeah, and I mean, I see more and more economists calling for get actual tangible assets, and gold is an easy way to do that, especially if you're a high net worth individual and you're looking to diversify your portfolio. We've spoken time and again about the risks of having a portfolio that's based solely in fiat currencies. We're seeing gold has just replaced the euro as the second largest asset in holdings among central banks. We're seeing that more and more there's a shift away from having dollar-based assets and having all of your faith in the strength of the US dollar and moving it away from that. There's a big shift happening globally in terms of monetary policy, and it's swinging towards gold all the time.
What's interesting is old Ray Dalio, the CEO of Bridgewater Investments. I mean, that is the biggest hedge fund in the world. And he came out, I mean, it's quite interesting. He's just done a recent podcast with old Stephen Bartlett from the Diary of the CEO. I haven't seen it yet. I've seen snippets of it, but I definitely am going to watch it. But he came out, and it was in one of the financial publications where he, as the CEO of that business, of an investment house, the biggest one in the world, said that you need to be allocating 10 to 15% of your portfolio into gold. And I mean, he made it abundantly clear. I mean, this was alternative kind of speech that a lot of industry experts within the bullion space were saying a couple of years ago. Now, suddenly you're getting major players within the normal financial space coming out saying, allocate portions, 10 to 15% of your holdings into gold, into bullion.
Yeah, and I mean, the reason why they're saying that is, we look at the US dollar, it's been the world's reserve currency for so long, and trust is being shaken a little bit in the US dollar. I mean, if we just look at what's happening, and we're talking about American economy and politics a lot, but it is relevant all the time because that's what shapes the world monetary
Policy.
policy.
Yeah.
Yeah, it is really, it's crucial to the rest of the world that we know what's happening there and understand what's going on, where it's heading. And from all the data that's available at the moment, investors aren't convinced. They are really worried about what's happening with the US dollar and the US economy in general. And we can see that in so many things that are happening these days. I mean, we were talking about the Fed that was going to have a meeting to see, are they going to lower the inflation rate, the interest rate? And yes, they did. They had the meeting, I think it was last
Thursday. Yeah.
Thursday. Yeah. And you know, it was lowered by 25 basis points, and they said it's expected that they will lower it again twice more this year and then once again in 2026.
What's interesting, and I mean, you mentioned this, is in the week since our last episode, I mean, gold broke the all-time high of over $3,700 an ounce. Silver smashed $41,000 an ounce, and
41, not
for,
41,000.
I know there's some viewers wish that it would be $40,000 an ounce,
I'm
but
I'm one of them. If it
yeah,
was $41,000 an ounce, I would be a very happy
you'd be
man
very
right now.
happy considering you hold silver. But $41 an ounce. So I mean, it's now sitting at around 42.30 there and thereabout. Platinum also has been exceptionally strong. It's just under under $1,400 an ounce. It's sitting there and it's very strong. And even palladium has been very strong. And again, it does speak of, and I saw this again in many publications, of a commodity boom, that we are in the midst of it. Where does it end? Where do we see gold going? And I mean, it's funny. We have these discussions on a continuous basis, as you know, with that silver crystal, well, silver shimmering crystal ball, that where is the price of gold going? And you know, beginning of the year, we said 3.5 would be good. We looked across the board of other market commentators, and that was pretty spot on the money, literally. And then within by mid-year, that was already gone. And then we're looking now, Goldman Sachs, they revised their outlooks for the end of this year in going into the final quarter. I know JP Morgan have done the same thing. And suddenly they're talking 3,800, $4,000. They now, some market commentators are saying that by the end of this decade, we will have gold at between $6,000 to $8,000 an ounce.
And it's not unrealistic. I mean, when we came into the year, I think, what was it? It was in January last year. Silver was sitting at $22 an ounce, if I'm
Yes.
correct. And right now it's almost double that. I'm looking at the live pricing now, $42.21 an ounce. We're looking at gold that's sitting at $3,654 an ounce, and that's live, that's right now. I mean, you spoke about all-time highs a bit earlier, and when was it? I think it was on Tuesday or Wednesday that I sent you a screenshot of gold sitting at 3,690 something.
It was literally 98 or
Yeah.
99. It
And
was just
and
short.
and your reaction was, "Is this live?"
And that's the whole point, is we living in history. And what's interesting is you mentioned that, you know, we speak a lot about America, but if we talk about um, empires. This is the American golden era of empire. The Brits have had it, the Dutch had it, and we go all the way through history, right down to the Romans and the Egyptians and so on. That these are periods in time where one country or one nation has a dominance over the rest of the world in actual monetary supply and dictating terms to the rest of the world. And it's kind of a cut paste and print, you know, cut and paste kind of thing, that it's done throughout all time. And interesting enough, I'm going to refer back to Ray Dalio. He's very big on seeing those market patterns and the historical basis of how these things have been done before, and they'll be done again and again and again.
And speaking of Ray Dalio, he's the one that also said, you know, America's economy is about to have a heart attack.
Yes, I saw that.
Yeah, and that was actually a very, very interesting way of putting it to me. He spoke about the debt that they have, and this debt is like, the what do you call it, cholesterol or whatever it is, clogging up the circulatory system of a human being, and that's what it's doing to the American economy at the moment. It's getting more and more and more, and at some stage, it's simply going to have a heart attack. And that is also, I mean, investors, the people in your institutional investment and everything, the economists are smart people. They see this, and that is why there's been the shift from investing heavily in US dollars, in US bonds, and the like, and it's shifting to investing in gold, investing in actual tangible assets that is not connected to a one fiat currency. That, as we all know, fiat currencies have their time and then they fall. we look at the average lifespan of a fiat currency, it's 26 years, I think.
27 years, yeah.
Yeah, around about there. And if we look at gold, once that fiat currency fails, if you still have that gold, you still have your wealth.
Yeah, and we see that. I mean, we see that with clients that purchased gold 5 years ago or bullion 5 years ago when the rand was at X. Yes, the rand has improved. It's sitting around 17 rand 30 odd. Yes, 17 rand 35. So from its highs where it was in the high 18s, close to 19, over 19 there and thereabout, that's a sign of a weak dollar. It doesn't give any indication to the performance of our economy. But what's interesting there is 5 years ago, people bought bullion with us at a rand that was hedged at around 15, 16 rand. And with the growth of those commodities, they have improved their status. They have improved that growth on those commodities. The other thing is also is as the rand depreciates, without even the gold price or silver price going up, they start to hold and maintain wealth.
Yes, that's very true. And I mean, we're looking at the Fed rate cut that has happened now. And so basically what that means is it's cheaper for people to service their debt, whether it's a house loan, whether it's just a loan or whatever it might be. And that encourages people to firstly go out and get loans, secondly to spend more money, which stimulates the economy. And you might be thinking, well, that's all good, is it not? But on the other side, what happens is it causes inflation. And basically, you get people who has more money to spend now. That increases demand. Companies begin upping their game, producing more, and eventually the demand is going to outstrip the availability or the supply. And suddenly now demand is up there, supply is down here. What happens? The prices increase and you get inflation. And that is the danger of bringing down the interest rate. And I mean, we've seen it so many times. As soon as inflation starts getting out of hand, what do? They up the interest rate. And it just makes money more valuable. And now the exact opposite is happening in America. They've already got a high interest rate for, in American terms, let's put it there. And they've brought down the interest rate, or they have a high inflation. That's the word I'm looking for. They have the high inflation. Now they've brought down the interest rate, and the two together is just the recipe for a bit of a disaster going on there, and people see that. So that's why they heading into gold. They're heading into tangible assets, and that's why we saw the gold price go absolutely ballistic. I mean, if we look at it, it actually crossed $3,700, $3,707. And if we, you sent me an article a while ago, and it was a bit delayed at that stage. But basically, what it said was gold has topped inflation adjusted all time high, which was in 1980, I think, in the 1980s.
1980, yeah.
And that all-time high adjusted for inflation, the previous one from the 1980s, was $3,590.
Yeah, and again, I think this what you're ultimately saying is the value of gold. I mean, but we look at the U.S. economy, we look that there's this need to stimulate the economies. I mean, we've gone on about Donald Trump with these tariffs, and the whole idea behind it is to boost stimulation within the economy. Again, you talk about the interest rate decreases and so on, and there's a hope that it will stimulate it, but it's also, as you say, the problem is it creates inflation. But we look, I mean, the American debt to GDP ratio is over 130%. It's not sustainable. It's not sustainable over a long period. Yes, they are a first world nation, and they have the infrastructure and the capabilities to maintain a very high GDP to debt ratio. But that also does come home, and I think that's what kind of what Ray Dalio was leaning against when he's talking about that heart attack. That things can't continue to keep going the way they are. Something has to happen, change, or we are going to have a collapse.
Definitely, and yeah, I was also about to refer back to Ray Dalio when you mentioned the debt that they have. To Ray Dalio's analogy of it clogging up the arteries of the circulatory system, and investors are worried. It's as simple as that. They're looking for safe haven currencies or safe haven assets, and immediately they head to gold.
Yeah, so let's just go on to another very interesting thing. We've spoken a couple of times about it, is the debt, I was going to say debt to GDP ratio, but it's a ratio. It's the gold silver ratio. We've spoken at length about it. I know that, for instance, the greatest that ratio has gone expanded out was in 2020, and it was March. I think it was the 27th, if I remember, or the 24th of March, where it went to over 109 at the time to 1. So, in other words, 109 ounces of silver to 1 ounce of gold. Subsequently, over the last 5 years, it's pulled back, and that ratio has narrowed into the band where it's sitting around, I think it's about 85 to about 89 to 1.
I'm actually looking at it live right now. It's 86.5.
Yeah. So again, let's just unpack that. I mean, in the 1900s, the ratio was as close as 16 to 1. So in other words, 16 ounces of gold to 1 ounce of 16 ounces of silver to 1 ounce of gold.
Yeah, and well, the reason for that isn't because there was a fixed price on gold and silver, but rather because gold and silver was the currency. So and it was like saying there's 100 rands or 100 cents to 1 rand. It was there is 16 silver coins to one gold coin, and that's basically the origin of the gold silver ratio, and that's why for so long it was fixed at that, what was it, 16 to 1.
Yeah.
16 silver coins for one gold coin.
Yeah, and again, it maintained throughout all the decades. The next big knock where there was a massive jump up in that ratio was in 1970, when old Richard Nixon removed the dollar from the gold standard. And there it shot up to 40 to 1. In other words, 40 ounces of silver to 1 ounce of gold. And effectively, also, what happened there is monetary policy was forever changed. That all the notes that are printed go, and actually, it's probably in one of the next podcasts, we're going to talk about the Roman Empire and how we can actually draw synergies to modern day. But a very similar thing happened where the actual currency value in actual monetary value became less and less and less. And that's massive and hyperinflation. We've seen it in recent times with Zimbabwe, where I've got a few Zimbabwean notes where, in fact, I'm a billionaire a couple times over in Zimbabwean terms. But again, 1975 was that period of time where it shot up from that 16 to 1 to 40 to 1. And then again in around 2000, silver lagged heavily, and the ratio spiked nearly to 60 to 1.
Yeah, and then we look at this year actually, where we've already seen 100 to 1 gold silver ratio. As you said, now it's pulled back to 86.5 because silver has increased in price. And it's interesting that it managed to do that. It just tells you how resilient silver has been, because gold is sitting at 3,650 at all-time highs, unimaginable numbers that earlier this year we would have thought, yeah, maybe next year, but it's already there. It's already past that. And so, yeah, we saw a gold silver ratio of over 100 this year. And it brings me to a very interesting little what do you call it? Not an investment trick, but some advice that some investors usually give out is what they call the 40-70 rule. So when it goes below 40, you swap to gold because silver is expensive. So you swap to gold.
In relation to gold.
Yes, in relation to gold, silver has become expensive. So you swap to gold for your investments. And then when it goes above 70, silver has now become cheap. So you swap from gold to silver. And the interesting thing is, if you follow this 40-70 rule, would have made 4 swaps in the last 20 years.
Yeah, and what's interesting with that is, in this period of time, and even now where gold hit that all-time high, and it retraced to, as you say, around $3,650 odd an ounce, it's not a massive drop. Even silver, it went up earlier to broke 40. There's a small pullback. It went back above 40, then went to 41, and now sitting around 42.3. So again, it's showing that where previous years, where silver, and we earmarked this already from 23, where we could see that the spikes, the gains in silver, where previously that it shoot up by $10 and drop by 12 and so on, those days are gone. The narrowing, and what that's showing is there's far more stability in the actual movement upward. And that does tell us that they are going to continue to increase over the long period.
And the other thing is that silver sort of has a double-edged sword where gold has a one-edged sword, if we can put it that way. You know, gold is expensive because it's rare. It's as simple as that. There's not a lot of it around, and therefore it costs a lot to extract it. It costs a lot to actually get that gold into your hands. And, you know, that is the reason why it is expensive to start with. You know, silver, on the other hand, it's more plentiful than gold, but it's still rare. It still costs money to extract. It still costs money to get that piece of silver into your hand. However, there's an additional demand for silver, you know, and that is industrial. If we look at the industrial demand for gold, it's relatively small.
In relation to its financial demand, absolutely.
Yeah, in relation to investment demand or financial anything to do with finances, the industrial demand for gold is tiny. Silver, on the other hand, more than half of all silver silver demand comes from industrial applications. And one of the biggest things here is solar power. I mean, we now see AI data centers, which, you know, is the big thing at the moment, which is growing rapidly. They're all switching to solar because it's a more reliable energy.
Cost-effective energy source,
Yes,
absolutely.
and what is needed for solar power? Silver. So there's a massive, massive demand for silver, firstly. Um, Secondly, the industrial demand is immense. And thirdly, there's been a deficit for the past 7 years, I think, in silver production. So all that adds up, and we can see why the silver price is being so robust at the moment.
Yeah, I mean, we've spoken also at length about the industrial demand on silver. As you mentioned, the photovoltaic market for the last couple of years alone was running at a growth of around 20% per annum. So it's a given. I mean, I've just saw an article here where Deutsche Bank has raised their gold forecasts to $4,000 by 2026.
And that might be pessimistic the way things are going, you know. It
Yeah.
was what a few weeks ago we were talking about $2,700 as this magical number again, you know. By then we'd gotten used to 3,300, then 3,400, 3,500. Now we're getting used to 3,600 and 3,700. Been there, done that.
Yeah, and again, reasons for this surging central bank demand, especially China, a weakening of the US dollar, political pressure on the Fed's independence, which is interesting. So this attack or perceived attack from the White House on the Fed's independence globally is concerning.
And you know, it is very concerning that there is pressure from the White House to decrease the interest rate, because I mean, as a government, you shouldn't be doing that. You shouldn't be controlling your central bank. The central bank needs to look at objectively at what is best for the economy right now and operate according to that. If you look at the reasons for lowering the interest rate, firstly, it's to stimulate job growth. Secondly, it's to boost the economy. And why would you need to boost the economy and stimulate job growth if there isn't a problem already?
Yeah, and again, I think what you're highlighting, especially with American politics, is very red and blue, and we know even right now, throughout internet, that it's very polarized right now because the views, funny enough, have become very extreme and very, as I mentioned, polarized. So this so it's an onslaught from the Republicans that are perceived to be putting this pressure on the Fed, wanting to uh, basically pressure them to their understanding of what monetary policy should be used and should be defined for America.
We know the American economy is not looking great, and I do think this is a desperate attempt to actually have it just it needs to look better. The current administration is very much into um, what things look, how things are perceived, the image, the what do you call it, the presentation of this is how great it is, and they can't really do that at the moment because it's not looking great. So they're pressuring the Fed to lower their interest rate, and as I said, they're already talking about two further interest rate cuts this year and another one next year. And all of that is to try and get the economy to look better than it really is. But, you know, people are seeing through that. Your clever money is seeing through that.
Just on any other thoughts with regards to for today's discussion?
Well, I think honestly, we're seeing a massive, massive shift globally in monetary policy. The US dollar, I don't know, maybe it gets itself out of the bind it's in, but it is in a bit of a bind at the moment. There's trouble heading their way. And unless they can find the sense to pull themselves out of that, I think there's a great chance that it might lose its its standing as the number one undisputed world reserve currency. We're already seeing gold take up number two of that, displacing the euro. So we're talking about gold going to 7,000-8,000 by the end of the decade. If that happens, I don't have much of a doubt that it will become the dominant reserve currency in the world.
Yeah, I'm actually smiling to myself because it's quite interesting. You see the history of gold from an investment, especially traditional investments, and it was always considered to be alternative. It was always considered to be, we don't do that, it doesn't, it's not a yielding asset, it doesn't make money, it only grows in its value. And yet it's shown the fact that Basel 3 has upgraded its status from a tier 3 asset to a tier 1 asset speaks directly to what you're saying, that there is this move. I mean, the fact that it surpassed the euro as the second dominant asset, that's utilized in the world, is already giving indication that the dollar, as far as the dominant or the global currency, it stays unnumbered. And where we will be by the end of this decade, as I said, so there are some market commentators talking of $6,000 to $8,000 an ounce by the end of this decade. We're a couple of what now coming up to four years out from that, or just over 4 years from by the end of this decade.
Yeah, and I mean, we talking about silver sitting at $42 and looking strong and being very stable. You know, silver's been coiling. The spring has been coiled, and years and years of deficit in supply, growing demand each year. It's just being pulled tighter and tighter, and it's going to let go at some point. And I think once it crosses $50 an ounce, we're in uncharted territory. It's never been that high. We don't know what's going to happen from there on, and we see people talking about $100 an ounce, which is also not entirely unrealistic.
Yeah, I think we're in for a very exciting period of time. I think when it comes to commodities, specifically gold and silver and platinum, I mean, platinum's definitely had a big comeback this year. It's been the strongest performing asset of the three. But the other two have also been performing exceptionally well, hitting all-time highs, pushing to, the boundaries. But as I say, more interestingly is when they hit those all-time highs, the retracing, the profit taking is not massive gaps. I mean, to break 3,700 and now to be sitting at 3,650 odd dollars an ounce is not a massive drop. It tells me that it's a recoil and it's a building into the next phase, into the next building phase for gold. Same with silver, we mentioned that, and same with platinum. They are laterally moving upward, if that makes sense.
Definitely. I mean, when we saw the previous profit taking around of gold sitting at 3,505, I think it was the first time it broke 3,500, we saw a drop by about $100.
Mm.
This time around, it's $50.
Yeah.
So yeah, it's interesting times all around in precious metals. As you said, platinum is up there, silver is up there, gold is way up there. It's it's very, very exciting to actually be in the field.
And again, from a financial perspective, the amount of products that are coming out in this space that are gold backed or physical gold backed and so on has just increased across the board. You go into social media, the amount of companies where we were in that space 5 years ago, and there were a handful of companies like ours, now suddenly they just all over, and offering different propositions of what makes them different and better and so on. But again, it does speak to that there is an almost an unnatural demand. And I think the average person in the street that doesn't understand bullion is starting to be confronted with it through advertising, be it while you're driving, on the radio, through social media, that there's a definite thing with regards to gold and bullion that needs to be considered when it comes to financial wealth management.
And it's interesting that you mentioned that. We talk about my favorite Kindle Bergaminsky model.
Yes, yes.
We've been through the stealth phase. We're in the awareness phase now, where institutional investment is taking up all of this gold. They're buying into it heavily. And the next is the mania phase. And when does that happen? When the general public starts to become aware of it, takes an interest, and starts buying into it. And we're seeing more and more of it leaning towards that mania phase right now.
Well, I'd even go as far to say as we probably entered the mania phase. If you see the growth in gold over the last year or year to date, 9 months, we definitely have seen a massive upward movement of gold. Same with silver. So, and again, we speak of that public awareness within all the different channels of media and so on. And it definitely speaks to a greater awareness, and that creates a greater buying, and that then stimulates that parabolic run where gold will go to $6, $7, $8,000 an ounce.
Definitely. I mean, we have to watch the space.
In closing, Willem, any other thoughts?
No, I think we've pretty much said what we need to say. Next week's going to be an interesting one. I think it's going to be a bit more of a history lesson than an economics lesson, which I'm
Yeah.
looking forward to, something different.
And I definitely also want to, I'm very pro African. And what I mean by that is with a lot of the projects I'm involved in, my mission is to make sure that we as Africans, regardless of the color of our skin, we need to start actually investing internally. The fact that foreign countries arrive on our soil and go and mine our mines and take our resources and leave without leaving any footprint behind of any internal growth has been a historical thing that's fallen upon the continent for decades. Is it the continent's fault? Yes, because of course there's individuals that were enriching themselves that didn't care for the communities, and they kind of just turned a blind eye. So of course it's never one-sided, but definitely want to look at it. I also want to look at the history of the Kruger Rand, because to me it was the first currency as far as a sovereign currency that came out. That's globally renowned. I mean, they've sold over 60 million ounces of Kruger Rands year to date. I mean, that's phenomenal. So we'll go into that story also next week.
I'm looking forward to it.
Anything else in closing, Willem?
Well, if you enjoyed the episode, leave a like. And if you want to see more, be sure to hit subscribe. And we will see you in the next one.
Bye. Take care. Thank you.